Welcome back. Today, I'm going to cover how we account for assets that we expect to use for more than 1 year, kind of like this tractor behind me. Typically, with my small business, I expense everything as I pay cash for it. However, expensive assets that I expect to last a long time, like this tractor, would cause a lot of distortion in my financial results if I was to expense them when I paid cash for the tractor. What I end up doing is taking the expense of this tractor and allocating it over the next, say, 5 to 10 years, depending on how long I expect this tractor to generate revenue for me. That way, I'm matching up the expense of the tractor with the revenue the tractor is helping me generate, thus improving my financial results. Today, we're going to update our accounting worksheet for long-lived assets and show how we allocate that expense over the life of the asset. If you haven't seen the video on the Accounting Excel worksheet, I'll put that link in the description below. With that, let's get started.
So we're going to build off of the basic accounting system worksheet that I set up in an earlier video. If you didn't see that, I'll put the link for that below, but we're going to build off of this and insert essentially kind of a long-term assets or long-term equipment type worksheet into this that'll easily integrate every single month so that we know what we're doing and how do we add these types of assets, and then how do we depreciate them, which is essentially using them up from an accounting standpoint to give us a good idea of what kind of expenses those assets are applying every single month to figure out whether we're making money using them or not. So this is what we have for the month of April. These were our transactions. If you recall, when we started the company, we put in $1,000 worth of equipment, and then we also purchased another $1,500 worth of equipment. That was in the first month of operations. Now, that was $2,500 worth of equipment. At the time of setting this up, we said, okay, it has 4 years of useful life. That equates to roughly $52 of depreciation every month. What that's saying is every month we are using up $52 worth of this equipment. So after 48 months, we will have used up all of the value of that equipment. Now, that doesn't mean we have to stop using it after 48 months. It just means from an accounting standpoint, we have extracted the full value of that equipment. Now, if we keep using it, we're kind of using it for free. So that's how we set it up when we did this. Now, if you have a lot of equipment or you go over time, it gets rather burdensome to be tracking this. You kind of have to keep a rolling total, like what equipment's rolling off, what equipment's rolling on, what's the new depreciation on the equipment that you add every month. It is possible to do it in the column, or you can set up a separate worksheet, which is what we're going to do today. So I'm going to start by creating a new worksheet. We're just going to call this equipment, and this is going to list all of my equipment. In the first column, we are going to have date, and then in each subsequent column, we are going to have a description of the equipment and then its useful life. So we are starting with April 30, 2020 is the first date. The next month, we're going to do one row per month, and you'll see why we do that and how that lines up here in a second. So then we're going to have May 31st, 2020, etc. Let's just run this out, say, for roughly 60 months. So that'll be through March of 2025. In general, most of our equipment for this business anyway is not going to run past 60 months, which is 5 years. So we should be in pretty good shape. We can draw that out as we need it and go forward. So this is how we're going to start that. We're going to say this is our startup equipment. I'm going to just format these, wrap the text. There we go. And then this is going to be our useful life in the second row. So this is going to be 48 months is our useful life. We are also going to add in here cost. So this is startup equipment. It was $1,000, and it's going to have a useful life of 48 months. Okay, so that means in the first month, we are going to be depreciating this $1,000 divided by 48. There we go. We're going to depreciate $20.83 in the first month, and that is just the purchase price, or in this case, it's the amount contributed to the business, which was $1,000, divided by 48 months, which is how long we expect to be utilizing this asset. So this is how long we expect this asset to generate revenue for us. And the idea here is that as this asset's generating revenue, we are going to take a little bit of the cost of this asset against that revenue, and that's going to happen over 48 months. And that means we're going to have to take expense of $20.83 every month. That is the cost of using this equipment, this startup equipment, which was, I think, some lawnmowers, over their useful life. Now, we also purchased some additional equipment, and I'm going to call this lawnmowers. $1,500 was our cost. And then again, we're still doing it over 48 months. So again, our equation is just going to be the 1,500 divided by the 48 months. Now, that's for our first month. But we want to be able to do this going forward. So what we're going to do is we're going to set up an equation for every month and just drag it down. So this was our equation in the first month. It was the cost, which was $1,000 divided by 48. In this case, we typed it in. In this case, we didn't put the months in the second column, so we could just refer to the 48 months cell. Now, if I just drag this down, it's going to move my reference cell, which is why all this becomes just messed up. That is not what we want to do. What we want to do is we want to make sure it's referencing the exact same cell every single time I copy and paste this formula. So to do that, I'm referencing cell B2. I always want to reference cell B2. So I'm going to put a $sign in front of B and a $sign in front of 2. That $sign means every single time I copy this, I always want it to stay referencing B2. I don't need to do it for the 48 in this case. I will when we do our second column. But for the first column, we just typed in 48, so it doesn't matter. So now when I copy and paste, or in this case, drag this down, for my 60 months, which I won't actually use, it copies it correctly. Now, I only have $1,000 I need to get rid of, and it's only going to last for 48 months. So I actually need to stop right around March of 2024. So that needs to be the end of my depreciation. This depreciation all needs to go away. So we're going to clear that contents out. That should give me a total of $1,000. We can look down here in our sum figure at the bottom, and it does. It gives me $1,000, which is my sum figure. I can also put sums at the bottom, but I'm not going to do that because that gets a little bit confusing. As I add additional years, I have to drag my sums down. But if you prefer to do it that way, you can. Now, the startup equipment, I am all set. That's why I'm depreciating it out. I'm going to do the exact same thing from a formula standpoint here, but I'm actually going to fix both of my formulas. And again, it's going to be over the same period of time, so I just need to drag this down here to 2024. And that I should have looked real quick down here. My sum should be $1,500, which it is. Now, the question is, well, how much depreciation do I need to record for the month of April? And then that's where we're going to set up a new column. We're going to call it monthly depreciation. Now, don't get bent out of shape by calling it depreciation. Accountants all call it depreciation, but this is just how much of the asset we're using up from a financial accounting standpoint. How much are we using up every single month? So there's my monthly depreciation. That's just going to be equal to the sum of all of my columns, which in this case is only 2. So there's my $52 of depreciation, which is what we had recorded back here in April at the end of the month when we did our adjustments. We recorded $52 of depreciation. Now, we rounded it a little bit. As you can see, we recorded 52 even. If you were to go back here, it's actually $52.08. So that was a rounding that we did just when we set up the spreadsheet. The 8 cents is not going to cause us major problems as long as you know that that's what you're doing. Okay, so that's what we have for April. We have depreciation of $52. Now, let's say we continue on. We're going to give ourselves some more columns here, add all those together, and extend our formula over to make sure we incorporate all of those separate columns. Now, let's say that in the month of May, we are going to purchase a tractor. This tractor is actually going to last us for 60 months. That is 5 years. We're going to spend, I don't know what, $15,000 on a tractor. So we spent $15,000. Let's just format all those a little bit prettier. There we go. $15,000 on a tractor. It's going to last us for 60 months, which is 5 years. Now we do the exact same thing. Here's our formula, $15,000 divided by 60. And we want to keep these cell references. So we're going to use our little $ trick here. And that's going to mean we're depreciating, or it's costing us $250 every month to use this tractor. And this is going to be for 60 months, which, okay. One quick thing. I think I mentioned we are putting this into service not in the month of April. We are actually going to put this into service in the month of May. So I do not want to put anything in the first row, which is because that's April. We didn't buy this until May. So we're going to put it right here. There's our May $250. And we want to run that for 60 months, which is actually going to take us a little bit past the last date we have here, but that's easy enough to drag this down. There we go. Now all of these total up to $15,000. We will be fully depreciating that tractor over 60 months or 5 years. And as we move down here, we now have, we can drag this as well for the time being. There we go. So there's our $52 the first month. Our second month depreciation, because we bought the tractor and now are going to be using that, that's costing, every month we have the tractor, it's costing us money, is $302 is our depreciation, or our use of of all of our equipment is $302. Now, a couple things to keep in mind. A lot of times accounting has salvage value, which means, okay, at the end of the useful life, maybe we could sell this tractor for $1,000, which is very possibly the case. Now, we could say, well, we're not going to depreciate $15,000. We're going to only depreciate $14,000. That is possible. Then we'd have $1,000 at the end and just say, well, it's worth that just as a bunch of salvaged metal. That's possible. You can do it that way. You just change what the amount is you're depreciating. So instead of depreciating 15, we could depreciate 14. In that case, we would just add a row here, depreciable base. That's the fancy accounting title for it. It's called depreciable base. That means we are not depreciating the full amount. So in this case, we depreciated the full amount, $1,000. In this case, we depreciated $1,500. In this case, let's say we're only going to depreciate $14,000. We're still going to depreciate over 60 months, but now we just need to switch this from going on the price to the depreciable base. And that decreases our depreciation by basically 1,000 divided by $1,000 that we're not depreciating it over those 60 months. So it brings our depreciation down to $233. So that's how we set this up. That means this is the amount we'd be recording in our worksheet every month. So as we mentioned in April, there is our depreciation being recorded as an adjustment at the end of the month. When we would then go to May, we would record our depreciation. We have it in here already because we copied it over. Our depreciation on our equipment would then be the $285.42 is what it would be. We just put that right there from this worksheet. So we just keep building this out. As you move through time and you fully depreciate stuff off, so the business lasts longer, you can just hide rows. So to hide rows, you would just go up here to, if you go to Format, Rows, and then you can do Hide or Unhide. But we're not worried about that. We just got started. So there's a quick overview of how to take your long-lived assets, get them into your accounting records without expensing them entirely right when you purchase them, but instead depreciating off the value of that over its useful life so that you have a better picture of how much you're actually earning with your business every single month.
Hopefully that was helpful. If you enjoyed this video, click the like button and subscribe to see future content. And if you want to see future videos from Accounting Outside, make sure you hit that subscribe button to get notified when I release new content as we explore the world of accounting and finance. Have a great day, and God bless.